So we'll break right into it. We're going to talk a little bit about managing crypto risk. So we have a lot of layer 1, layer 2s building really cool stuff. But we also have companies that are out there trying to mitigate a lot of the risks that inherently come with blockchain technology and interacting with transacting in blockchain technologies. So by quick means of introductions, we have Roger Brown, Global Head of Tax Strategy at Chainalysis. We have Adam Levine, VP and Head of Corporate Strategy at Fireblocks, and Noah Buxton, co-founder and CEO of the network firm. So, Roger, let's talk about Chainalysis and how you're seeing more integrations or more interest from auditors, accounting firms, and tax firms that are now using your company's technology in solving their problems.
Great. Well, thank you. Great question. And I think it's important to divide the use case in different buckets. So accounting firms, law firms, and the like really begin with almost the same beginning point that many crypto businesses. Do I want this person, this business as a customer? What are they doing on chain? And as someone who's a former partner at a Big Four firm, one of the biggest challenges to getting business is getting that company through the risk and client onboarding procedures. And having an objective measurement to say, do I want this kind of client? What are they doing on chain? What services are they doing, et cetera? That's one way. Even do they have the ability to pay? What is their on-chain wealth? So that's the first exercise. The second exercise is tax. There's IRS regularly and governments around the world believe there's underpayment of current tax. In the most recent broker reporting regs, the IRS says compliance is less than 50% when there's not adequate third-party reporting. And when one looks to historic reporting levels based on the number of customers exchanges say they have, and number of tax returns reflecting crypto in 2015-16, less than 1% of Americans reported their crypto activities. And a lot of accounting firms and law firms are busy with doing almost forensic due diligence and people finding religion with regard to tax, quite frankly. And there's many of those kinds of engagements that law firms and accounting firms are doing, including people being contacted affirmatively by the IRS because they've publicly have issued John Doe summonses to the largest exchanges. They're getting names, they're getting on-chain wealth, and they're seeing what activity is happening, and then they're comparing that with filings of people who've gone to Puerto Rico to Crypto Beach and seeing like people have really gone aggressive and seeing those, pairing those data sets, and it's a different kind of discussion. And then thirdly, for accounting firms, just purely what we talked about today around audit and the kinds of disciplines, very much so, we are not an accounting firm, Chainalysis, but we supply the data that's powering the kind of activities that the accounting firms and law firms are doing. For block explorers don't have a SOC 2 Type 2. We do. So therefore, when people are using our tools, they shortcut a lot of the procedures that they have to, or can ingest and use our clustering heuristics for purposes of saying, what are all the wallets? What are the historical balances? What are not the customer's wallets? What is evidence of wash trading? What is not evidence of wash trading, so I can properly record revenue, and I can do these sorts of things. Or if there's data that's missing, and that's what we commonly hear from tax lawyers and accountants, you can see what could be missing because frequently where people don't have diligence around activities, they have that. And then lastly, around AML, KYC, where increasingly regulators are pointing to things like DAOs, where they're saying they have those kinds of obligations, they're able to give advice and say which type of tools can satisfy a regulator that they're minimizing these kinds of risk.
That's great, and I know Cryptio is also considering integrating with your tool, because just to give the frontline accountants, the people that see these transactions on a daily basis, who need to be reviewing these and giving it a score, so they could raise the red flag sooner than later.
I'm glad you mentioned that, because I had a great chat with one of your colleagues around, you guys are doing work around basically looking at on-chain gains. We actually have been a bit disappointed in some of the quality of on-chain data, about not properly differentiating between economic events of fee income and gain income, where we've been leaning into that as a data source to say, okay, how can we apply that to you guys or accounting firms, because the tax law does differentiate between how an accountant's policies as well as to how people earn from DeFi, because fee income is different than gains and therefore has different accrual mechanisms, whether or not you're withdrawing that liquidity.
That's right. And so Adam, how do you view the tech risk and regulatory risk, and how do you view partnerships with others in the industry in helping solve these problems?
Yeah, thanks for the question. I really appreciate Cryptio having us here. So first of all, Fireblocks. We are a digital asset infrastructure or technology provider. Oftentimes the market thinks of us as a custodian, but to be precise, we provide the technology that helps power many in the industry, many of you, to go down whichever path you choose in the digital asset journey. Often at Fireblocks, we think about 3 types of risks that our clients need to be concerned on. One of them is very broad, which is reputational risk, and that can come out in a variety of ways. But then we think about cyber risk, and last, regulatory and compliance related risk. And that's not in order of importance, right? It depends on where you sit and which risk gets exacerbated on any given day. That's most important. So reputational risk, we won't fully go into, but when it comes to the cyber related risk, that's where we believe we shine, and we actively encourage the industry to think about multi-party computation, or MPC, as a critical component to your digital asset infrastructure, right? Whether it's us or others that have similar types of solutions around MPC, absolutely critical, right? We say that if you can't hold your assets in a safe and secure way, nothing else really matters. But once you've checked that box and chosen someone like us, you then, depending on the type of institution you are, you really need to be quite thoughtful about your regulatory and compliance risk, right? And some of it is a risk appetite, but you don't get to say, hey, I'll see if it's Bashar al-Assad on the other side of a trade, right? That doesn't work. That's not something that mature companies can just risk accept. And if you're regulated or have serious stakeholders, they obviously want to accept that. So at Fireblocks, what we've done is partnered and integrated with institutions like Chainalysis and Elliptic when it comes to some of the on-chain analytics. And now, as much of the market is thinking about things like travel rule, working closely with companies like Nota Bene and looking at the trust solution, really to help power our clients so that they have the best in class for those solutions to help them mitigate those risks.
Can you go into how you're working with Nota Bene?
Yeah, so the way it works for us is that we've integrated with Nota Bene. Nota Bene is a little bit earlier stage company, but focused on travel rule compliance. Depending on what jurisdiction you're in or who you're trading with, travel rule is absolutely essential for virtual asset service providers. So our clients that are VASPs, the virtual asset service providers, can procure Nota Bene through Fireblocks, have that integrated solution, therefore allowing them not only to mitigate the cyber-related risk with the MPC wallet infrastructure, but then be able to comply with the travel rule requirements. And what we think is special about Nota Bene is it's not just one travel rule solution, but they've integrated with a variety of protocols, and they continue to do that. And that's similar to the approach that Fireblocks takes. We don't take a bet on any given layer 1 or layer 2. We look to help power our clients, and they're going to choose a variety of different protocols. And so just like we do with the blockchain protocols, Nota Bene has a similar approach when it comes to travel rule.
Thank you. And Noah, maybe you could go into a little bit of how you started Network Firm, what you're doing, and then get into more high-level questions.
Yeah, sure. Thanks for the opportunity. Good to see a lot of old friends here. So, yeah, the Network Firm is a CPA firm. We're a hybrid tech and CPA firm. We were founded actually early this year, but the founding team, about 12 of us and 5 developers, benefit from being in the space and since about 2016, working at a top 20 CPA firm, and I used to lead an industry practice there that served all manner of needs from financial statement audit through tax and consulting, risk assurance, etc. So yeah, today we are focused really on 2 main things. We're focused on advisory services, some of which you've kind of heard about today, right? The outsourced accounting of the world, some of you work in that, and tax basis tracking. And also, what we're really, really good at and what we've innovated and been recognized as leaders in is this idea of proof of reserves, transparency, tech-enabled attestation, essentially trying to solve the problem of asset and liability mismatch or non-visibility into assets and liabilities, whether that's in an exchange, custodial use case, you're a customer of an exchange, you've deposited a Bitcoin. Is that actually reserved? Is it held one-to-one in a like-kind asset on your behalf or not? Stablecoins, right? Are stablecoins actually adequately reserved with cash and cash equivalents in the way that they've committed to their customers? And other types of financial instruments come into play too. Things like exchange-traded notes that are backed by some crypto asset or a hedge of some crypto asset. And so in each of these use cases, and we will see more, by the way, right? The promise of tokenization of real-world assets is more tokenized dollars, right? And more tokenized commodities and more tokenized ownership interests. Maybe that's in real estate or its partnership interests or the like. We're going to continue to see an on-chain representation that has maybe a real-world asset representation, but we as accountants and auditors need to help solve that problem for the digital asset space. So that's what we're really focused on.
And how would you categorize treasury risk management when you look at companies?
Yeah, so that's a huge topic. I think going down the line, we've sort of got regulatory compliance and risk compliance and operational and custody. When I think about treasury generally, I think there's kind of 4 buckets that you can put all of your risks into. You've got sort of operational, you've got market risks, you've got liquidity risks, and then you've got counterparty risks. And so anything that you deal with in your business or serving your clients, you can kind of fairly bucket into those things, right? So operational, are my people going to steal the company money? Market, is the securities that I hold as treasury on my balance sheet or other assets or tokens subject to significant volatility such that my treasury could be impacted, my going concern could be impacted. Market liquidity, right? Are the assets on my balance sheet sufficiently liquid to meet the needs of the company? And then, of course, counterparty. And here's where I want to make the distinction. Like when I think about this, I think this is an important topic for us all to think about, is many of the companies in the space today essentially serve a custodial service, right? They provide a custodial service. And so here, Treasury kind of has a fork in the road where you think about company assets and you think about customer assets. And the past year that we have all lived in this industry has been fraught with examples of failure of custodial models, whether it be in crypto exchange, crypto lending, other tokenized instruments, right? So Terra Luna, right? Go down the list. The BlockFis, the Voyagers, the Celsius. It's basically a whole pile of companies that have harmed consumers, right? There's a whole number of millions of people that have been harmed because they didn't have adequate visibility to assess their counterparty, right? Those are just consumers, individuals. But at the institutional level, we all need methods and modes and tools for transparency so that institutional businesses can assess their counterparties, right? We heard from the Grayscale bigwig earlier today. He said that was a core part of their audit, right? How do you assess your counterparty risk? It's just block and tackle in traditional finance, and it's something that is not completely absent, but we are far behind in digital assets. The thing that's really frustrating is not only are we far behind, but we have an incredible opportunity to be better than traditional assets, right? Most of the counterparties or banks that we rely on in our TradFi part of our life, we know that they are, partial reserve models, right? We know that there is leverage, and we know that there's leverage in the system, essentially. And we have regulators and oversight and all kinds of things and audits to help protect that leverage from coming out of the system and harming consumers. In crypto, right, we have companies that promise us a one-to-one reserve on the exchange, or we have stable coins that promise us, adequate price peg by holding actual cash and cash equivalents. But we don't have the means to prove that. Well, we do, but it's not adequately adopted. We have proof of reserves. We have auditor-assisted, limited attest engagements that can help close this transparency gap. But firms, as a prior panelist noted, firms are being threatened essentially from doing that type of work. And again, it's frustrating because the ultimate result of that could be a much better assurance product than you see in traditional finance. You could have not only financial statement audit, but you can have these limited attest proof of reserves on top, which give transparency that you just don't have, right? And if you question this proof of reserves as valuable, I would ask you, for all of the exchanges that you might use as counterparties, how was it last time you reviewed their financial statements, their annual financial statements, right? Unless it was Coinbase, you haven't seen their financial statements. You haven't seen their balance sheet. And so I think that kind of is one way to prove the point.
We're actually seeing also regulators want that kind of visibility. And one of the earlier panelists talked about the crypto ecosystem is $1.2 trillion, which is basically a speed bump in the real economy. But then when we think about what regulators are doing, particularly with regard to segregation of company and regulator assets, again, looking for visualization, which they can do on chain. So if they had a dashboard to look at which are company wallets, which are customer wallets, I would like to see those. And at any given point in time, you could see not only the segregation of those two, but also exposure limits to affiliates. And that exact kind of thing would have stopped FTX from happening, for example. And those kinds of things regulators are very cognizant of around the world. And I know in Texas, for example, there was a recent statute that came out and actually enacted a rule around exactly that kind of segregation.
Yeah, there's great progress, but it is a mixed bag, right? So I think globally, generally speaking, regulators have, yes, of course, are the assets there question, right? The obvious question has been asked by regulators, and they say, oh, there's tools for us to be able to see that and oversee it. Great, let's have those tools, or let's write that into the regs. And so we've seen that. Texas, again, is a perfect example. But in the US, unfortunately, we haven't seen that same sort of embrace. I won't speculate as to why, but on this panel. But unfortunately, yeah.
So, no, I want to pick up on the point around in traditional finance, there's certain risk, counterparty risk, that is just bread and butter. It's core, as you were saying. And in the digital asset world, we do have an opportunity to solve it in a better way. I think we've seen the industry decide that, oh, it's digital asset, therefore the old traditional risks don't matter. Clearly that was wrong. And anyone that thought that was just thinking bull market mentality. But what is really exciting is not just crypto, but if you think about the broader digital asset space, as traditional assets come on-chain through tokenization, you can use the technology through payment versus payment or delivery versus payment mechanisms and smart transfers to mitigate these risks that today there's enormous infrastructures in the industry that exist. So clearinghouses and foreign exchange at CLS, these are hundreds of millions of dollars a year the ecosystem spends mitigating different versions of counterparty risk. And one of the panelists earlier was talking about how you can quantify and explain to regulators or even to stakeholders about the value of the technology. This is where we see the market going, of taking traditional assets, bringing it on chain, and using a better version of technology to mitigate these risks. And it allows for cheaper transfer of assets, but also at the same time, the mitigation of these risks that the industry has solved through really expensive infrastructures today.
I would agree with that. And if you think about the ecosystem and how it's shrinking in many ways, yes, maybe in the last few months it's grown. This aspect of the ecosystem, I think, is the one that shows the promise. And even this morning, the most recent article about Andreessen Horowitz investing actually in a business that was actually doing exactly that, about bringing TradFi into the Web3 environment.
Thanks. And Noah, you brought up that there were 4 key risks, and I think proof of reserves would be one of the main gaps that you need to fill, right? So what are some of the examples of how proof of reserves have helped companies in your eyes?
Yeah, I think it's always hard to prove the negative, maybe is one way to think about it. For instance, X company got a proof of reserves and demonstrated to their consumers at a certain frequency, their customers at a certain frequency, that they were properly reserved, right? And therefore they didn't fail. Well, that's kind of hard to prove, right? Because there's a lot in that mix. But I think the opposite case is very apparent, right? In terms of, again, I listed some of the names, right, of the large crypto lenders and exchanges and institutional lenders that have collapsed over the past months. And so yeah, I think from maybe even start from the regulator perspective, right? Regulators think about detection, they think about deterrence, they think about prevention generally, right? So like, is this regulatory framework going to deter a bad act, deter a fraudulent act by management of a regulated company, or if it's not fully going to deter it, if that doesn't catch everything, right? Do we have at least some detection, right? Can we as a regulator sort of have sufficient oversight so that we can kind of catch a bad actor, let's say? And in traditional finance and money transmission in the US, it's really been the financial statement audit that does all of the heavy lifting there, as well as periodic or surprise inspections and things like that, right? Depending on the regulator and depending on their activity. So I think proof of reserves really, again, offers this general idea, whether you call it proof of reserves or not, right? There's regulators across the US, they don't call it, or excuse me, across the globe, that have adopted these ideas. They don't necessarily call it quote unquote proof of reserves, but the idea that you should have more frequent transparency into custodial reserves or custodial holdings or collateral for a tokenized instrument, that you should have that transparency more frequently is really valuable. It's a significant addition to like the regulatory picture. So yeah,
That's great. So I think a lot of these risk mitigations come from identified events that happen, and how do we solve those? But what other things are your companies thinking about looking forward, and what do you see as some of the industry risks ahead based on the new technologies and what's maybe unforeseen, where you guys are trying to put your time and focus on for the next level of your company solving these problems? Roger?
I think industry risks, we're seeing hacks as a pervasive problem, particularly around DeFi and bridges, things like that. I think that, although this is not our line of business, looking at increased assurances for auditing the code and the like is a trend that we think is welcome. One of our core strengths and where accounting firms often use us is to use our tracing capability and services and risk identification for purposes of, if there is a hack, how to find out where the funds may go. We tend not to serve most of the private sector inquiries that come to us. We actually prefer to license our technology to service providers in the industry and have them go and do a lot of the private sectors. There are exceptions. Publicly, we are part of the asset recovery work for FTX. That is public. So there are certain instances that are of a scale where we will get involved. Obviously, we were also involved in things like recovering the Bitcoin when the East Coast pipeline was held under ransomware, and ransom was paid in Bitcoin. We helped get not more than 90% of that back. Those are the kinds of things that we are continuing to invest in, expanding more our coverage of more and more blockchains, more and more interactions, more and more nuanced interactions with regard to how people are earning and transacting on the blockchain, doing more behavioral analytics, things like what do wash sales look like, what does pig butchering look like, what are rug pulls, what are the on-chain indicia, and then designing dashboards so that hedge fund investors, people who are running those kinds of platforms can use those tools to detect that, provide guardrails so that there is real price discovery and not price distortion. Even in the most recent broker reporting regs for the IRS, they indicated that wash sale price distortions are a real problem. Looking at someone ingesting our kinds of data so that the on-chain prices that people see are more reliable and that are teased out. That's where we see, in terms of the maturation of the market and how we see this moving forward, and people having a real desire for those kinds of tools that build trust in the ecosystem.
That's right. And Adam, Noah, any thoughts on how your companies are investing their time and money for the next step? Not what you're solving now, but what are you guys looking forward to in solving in the future?
Yeah. So one very big growth area, and I'm sure all of you heard about, is tokenization, right? Bringing the real world assets on chain, the traditional assets on chain. That to us is the next step. It's not instead of crypto, it's in addition to crypto, but leveraging a lot of the innovation that the crypto experience has and bringing that to traditional financial players. So as a result of that, we're spending a lot of time thinking about smart contract development, right? That's the process with which Solidity developers and others are bringing those assets on chain and thinking through the different ways with which something could go wrong, right? And making sure that there's real confidence in those smart contracts. So we'll be sharing more news in the coming weeks, but really working on some of those projects, as we've announced in the past, around National Australia Bank with 7 different stablecoins, Tel Aviv Stock Exchange bringing government bonds on chain. Right? Doesn't really get less interesting than government bonds, but it's fundamental, right? It's a great signal that this is where the market is going, and we're seeing some really interesting use cases around money market funds, amongst other. So that's an area that maybe not unique. The industry is picking up on it, but we're going to continue to focus with our clients and really help bring the level of on-chain assets up from the traditional financial world.
Last
I
thoughts?
guess maybe to the risk question first, I'll take both maybe. Sort of things I'm thinking about from a risk perspective, and then also what are we building for the future. So for the risk perspective, there's all kinds of things. But one thing I would say to this audience, and something that I see and I think we should all care about, is the risk to sort of accounting and CPAs generally. I know there's a lot of them in the room. And I think that the trend is pretty negative right now in terms of CPAs being able to provide good services to clients, right? Like, I think everyone in this room is a good actor. The reason you engage with clients is to provide them good service and to solve problems. And ultimately, those are beneficial actions to the overall space, right? I don't think that there's any negativity in providing services to the digital assets industry. But unfortunately, in the U.S., there's certain language that's been used or alerts, that kind of pretty clearly state the case that, sort of that service provider level is under attack, I guess you could say. Frankly, it feels like a bit of a choke point 2.0, right, to me, right? It's one way to attack the industry, right, is pull the legs out from under CPA and accounting services, and that's a really key service provider to any capital markets or finance use case, right, or any company. And so I think that's a big risk. I think, how do you solve it? I don't know exactly, but I think getting involved, I've been a member of the Digital Chamber for years. Great industry group. They do great work. And so, all of us should be involved at that level, I think, is the best thing that I would say. And then on what we're building, we've been pretty lucky to have good foresight on what would be, coming down the pike, or, how we could develop tech to do more frequent or real-time attestations over, novel use cases for crypto assets. So for the next 10 years, I think we got a good strategy, but essentially it's bringing transparency to that asset liability mismatch that I've talked about a number of times. And I guess the bleeding edge of that is bringing data on chain directly for use by smart contracts. So let's say a stablecoin, right, that needs to have sufficient reserves to maintain its peg and its redeemability for customers, right? Well, couldn't the smart contract also play a very interesting control role in that, right? It's code. It's going to check, hey, do I have sufficient reserves in order to mint new tokens or not? It's a programmatic control. It's very strong, and so we're facilitating that by aggregating data for reserve assets, providing it on chain through the Chainlink network, and that's it's in production now, right? It's being used actually for this sort of infinite mint type attack. And so I think more of that in real world asset tokenization is going to be a cool use case that we will address.
All right. Well, thank you very much, guys.